All right. Well, it sounds like we've got maybe the new attendees starting to stop the drip. But first off, let me turn on the camera. All right. Well, all welcome to a another quarterly investment performance review. Um, I have to say, after a day like today in the markets, it's a lot more fun to have an investment review. Um, Unfortunately, it seems like the bounce back of the market didn't happen before the end of last quarter. So the agenda for today is we really have two key topics. The first is we're in 5,500 season. So we're going to be talking through and giving everybody an update on what we're doing behind the scenes to get this year's Form 5500s all ready and out the door. And then, of course, we're going to go through the fun part, or at least for me, which is the quarterly investment performance review.
5,500s aren't fun for you?
It's a low bar.
Yeah.
It's a low bar. In any event, as always, as we go through this, please chime in with any questions you have. The last item at the end of this, we'll just open it up to any thoughts or questions related to pretty much anything that we're not covering. So if you have anything that's not on this agenda that you want to talk about, we'll open it up at the end. With that said, so it's Form 5500 season.
Yeah, real exciting. As David kind of alluded to, it's not always the most fun topic of conversation, but it is a really important thing that we do for all of our sponsors each year, is to help make sure that those 5,500s are completed, reviewed, and signed, and of course sent back to the DOL so that everybody's in good shape in regards to all of their administrative filings. What is a 5,500? Well, you're probably familiar with this if you're on this call, but at a high level, it's just the business owner's way of telling the government what's happening with their retirement plan, how many people are in it, what types of benefits are being offered, and are they keeping it up to date. So it'll have all of that administrative information, the summary of contributions, net inflows and outflows over the course of the year. And of course, it is a timely form that we need to fill out. It's due 7 months after the end of the plan year, assuming that you filed for that extension, which we do by default. Okay. So a little more detail. I think the gist of it is, if you wanted to have a comprehensive overview of where your plan sits, and look back over the course of however long your plan has been operating, to see how it's changed. That's what the goal of the 5,500 is for. It's to provide the Department of Labor and IRS auditors the basic information they need to kind of check in and say, all right, well, does this appear to be a well-run plan, or are there any red flags? So at the top, it's going to have all of the really basic information about who runs the plan, who's responsible for it, who's signing off on the form and attesting that this is in fact all true statements that we're going through. It's going to have a statement of your 401k plans participants, how many were added, how many left, how many folks still have balances in the plan, how does that compare to who's eligible, and same sort of deal with the assets. How many were added, how many left, how many were withdrawn for various reasons, how many loans are outstanding. All of that sort of information is on the form, readily available for review. It's also going to have some information about your service providers, including us. But think about your record keepers, the mutual fund companies that have hold the assets, and the custodian, and of course the advisor.
So is it fair to say that the 5,500 is kind of like an income statement, a balance sheet, and a cash flow statement for the retirement plan all rolled up into one?
All wrapped up into one. That's
Fair
it.
enough.
Yeah. And one other, I guess two other things that are, I think, important to point out. The fidelity bond. This is information that's on there, basically letting the government know that you are actually carrying the appropriate insurance on your plan. We'll talk a little bit more about that in just a moment. And if it's a large plan, way more detail is required, and there will be a number of other schedules and an accountant's audit report that needs to be attached to that as well. So good reason to stay under 100 people, because that gets a little bit more complex once you do get over 100 or so.
But even in the case of a large plan or the short 5,500, we're still doing all the work, preparing that, working with the outside auditor if required to pull that together.
That's right. The only thing that we ask you to do is to help out by filling out a short survey, and which you should have seen in December if you were around at that time.
Fantastic.
Great. And so I kind of mentioned that the DOL and the IRS, they use this form as kind of a first check for what plans do they want to look at. So what types of things on the 5,500 might trigger an audit? Really basics are not filling out all the information that you need to fill out. So if there's schedules that are required for your plan that you didn't fill in, that's a pretty good indication that maybe not all boxes are being checked. If it's late, well, it sounds like you don't have your ducks in a row. That's definitely a red flag for an auditor. The other thing that's somewhat maybe not the most intuitive, I mentioned that fidelity bond on the other page, but if you have a missing or a fidelity bond that's lower than the required insurance amount, real simple thing to check, but it also betrays a lot about how the plan is run. If you're not keeping up on that, maybe you're not keeping up on everything else. It's like that, like when Van Halen hosts a concert and they ask for those brown M&Ms. It's not so much to see if you can find some brown M&Ms, just to see how deep into that rider did you read, or how well run into your 401k plan are you.
Fair enough. And just to be clear, these are all things that we're checking, making sure correct before we file the Form 5,500?
Every single one of these is a part of our review.
And last year, out of the more than 300 clients that we worked with, how many of them triggered a DOL or an IRS audit because of an error in any of these areas?
Not a one.
All right.
All right. Great. So it's kind of, this is the real takeaway. As your 316 fiduciary and plan administrator, ForUsAll is trying to take care of as much of this work as we possibly can for you, including the preparation, the review, the signing, and the filing of the form. For plans that do have an extended tax filing, or if you're a large plan or haven't funded their employer match, we file extensions, so you don't have to worry about that. And as long as you've completed that short survey that we send and we request at the end of each plan year, you're going to be all set. And apologies in advance if we hound you on that. It's good information, though.
But if we haven't gotten it, we're going to definitely reach out and let you know.
That's right.
Fair enough. Perfect. So that's the quick overview of the Form 5,500 process that our team is spending a ton of time on right now. Let me pause there. Any thoughts or questions? All right. Well, let's talk about the Q1 2018 performance. As you all may have noticed, it was a mixed bag this last quarter. We saw broadly declines in both large cap equities, small cap, mid cap, almost across industries here in U.S. equities. I think the only industries that tended to perform well, and we'll talk about that in a little bit, tended to be more consumer staples. Internationally, our poor performance ended up dragging down the international economies, especially the developed region. The one shining light on the stock market side were really the emerging market economies, and that was largely led by companies like Brazil. That had a pleasant surprise. Oddly enough, there having a president uh, go to jail is actually a good thing for the stock market. And everybody was relieved that he wouldn't be running again. And so that boosted Brazil. And that was a key reason why we saw a positive performance in the emerging market economy. On the bond side, we'll talk a little bit about this. US bonds were also down. And that was largely a result of continued strong fundamentals in the macroeconomic environment, which overall led the Fed to bump rates again towards the end of March. I think it was on March 20th or 21st. And of course, as yields increase, bond prices fall, the net result was an overall negative. Global bonds did a little bit better and eked out a positive return. So that's the quick overview at the high level. In terms of digging a little bit deeper, there were a lot of factors that went into what was really a bumpy ride for U.S. equities. The quarter started off strong. We had tax reform, really robust earnings, and as I mentioned, strong macroeconomic fundamentals, which got even stronger. Some might say a little too strong. If you caught the news today, the unemployment rate fell below 4%, which is already below what most economists would say is a full employment economy. That just means that it's getting a lot harder to hire people, to keep them. And that, all else equal, leads to the second part, the uncertainty. During this last quarter, while it started off strong, we had a couple of things flare up. The first was growing tensions between some of our largest trading partners, leading to growing concerns around trade wars. Also, because of the very strong labor market, we saw a marketed increase in overall inflation expectations. That led to not only the rate hike that we saw, but concern that we're going to see even more future rate hikes. On the tech sector, had a really tough quarter. There's growing concern about different forms of regulation that might negatively impact some of the largest market cap tech companies, whether it's companies like Facebook around security concerns, or whether it's companies like Tesla around either concerns of their overall degree of leverage or the future of autonomous vehicles. All of those worked against both, the tech sector, which has traditionally been one of the stronger performers over the last few quarters. That negative sentiment that began to emerge in the second part of the quarter not only hurt the economy here, but a lot of it spilled over into the other developed economies. Particularly China was hard hit by the concerns around overall trade wars. The graph here on the right is an interesting graph. And this really tells the story of what the market sentiment is about potential future inflation. The green line there is the expected inflation. The blue line is that's the risk premium that's required by investors to loan money. And then the orange is the overall inflation risk premium. When inflation risk premium spikes, that tends to give you a sense that there are wildly divergent views on what inflation might do. But you see the orange line and the blue line are essentially flat. What you see, though, is the general downward trend of inflation expectations, which really dropped down in the 2008-2009 period. It's beginning to creep up. And in fact, in this last quarter, we saw a pretty big spike, or at least relative to recent history, on overall inflation expectations.
What are the implications of that spike? What if that kind of continued up and to the right?
Well, great question. It means that we might need to rethink the overall market consensus for what interest rates are going to do. As we all know, the Fed is very concerned about tamping down any sort of high degree of inflation. A little inflation is great. Not enough is a bad thing, and way too much is even worse. And as a result of the increasing inflation expectations, we saw bond yields actually increase across the board from the short term to the long term by about 30 to 40 basis points. So that means that if you want to borrow or lend money to the U.S. Treasury, you're going to get an extra 30 to 40 basis points over a 1-year time horizon, and about 30 to 40 basis points more over the 10-year time horizon. So we saw a general increase in the overall yield curve. Interestingly, though, we also saw a flattening of the overall yield curve. Now, as a result of the increase in the interest rates, we saw a decline, negative returns for both investment grade bonds. These would be U.S. Treasury bonds, corporates with very high credit ratings. But then we also saw negative returns from high yield bonds and non-investment grade bonds. And those high yield bonds and non-investment grade bonds were hit really with a double whammy. You had the rising interest rate, and as the equity markets decline, you tend to see greater pressure and widening credit spreads. All else equal, that means that those high yield bonds tend to post negative returns in that sort of environment. The graph here is really what the Federal Reserve has done with interest rates. And you see two lines here, and this is basically the lower and upper band on what they're shooting for. So if you remember the good old days of 2009 through, 2015, the Fed was targeting rates between 0 and 0.25%. And they've been steadily marching up. And as I mentioned, we saw another quarter point rise at the end of March, and citing the brighter economic outlook, the Fed continued to increase its future expected increases in the rates, and it's now looking like we might see 3 rate hikes next year, whereas previously people were thinking it might be closer to 2. The good news is the Fed is following a very measured approach to raising interest rates. And as I'm sure if you like to geek out like I do on a lot of the financial news, there's a pretty big diversity of opinion within the Fed as to how quickly to raise rates. And those two views tend to be balancing themselves out, and they continue to follow a rather measured rate increase environment.
What's the worry about raising them a little bit quicker?
Yeah, so while we do have one of the lowest unemployment rates, we also have one of the lowest labor participation rates. Actually, the labor force participation rate peaked in 2000 and has been steadily declining. So a lot of economists are saying, well, yeah, we have really low unemployment right now, but that's just because a lot of people have taken themselves out of the labor market during 2008 and 2009, and they still haven't come back into the labor market. And so one camp at the Fed says things aren't as good as everybody thinks they are. Another piece of data that they point to is if unemployment were truly as low as it appears based on the figures, we should be seeing much higher wage growth. And the wage growth numbers that we've been seeing have been rather modest. That leads many to argue that what we're doing is generally slowly removing some of the slack in the labor market that was created in 2008, 2009 when people pulled out of the labor market overall. So that's on one side of the camp. The other side of the camp is definitely worried that, especially as we continue to grow with such strong fundamentals, that we're going to quit. And given the level of leverage that we have, both in the private market and overall in the public bond markets, that we're just waiting for a moment that one of my favorite economists described as a Wile E. Coyote moment, where you're running along and then all of a sudden you just drop off that cliff. And in that concern, people are concerned that we could see a huge regime shift and a sudden spike in the overall interest rates, which could be driven by a sudden spike in inflation, oftentimes caused by fundamental changes in the overall currency markets and foreigners' willingness to lend to the U.S. at cheap rates. So they're two widely divergent camps, but they tend to be balancing themselves out. And what we get are one, heated, passionate debates about macroeconomic and monetary policy, but actually a very steady, measured response to the overall interest rate.
Okay, so a lot of excitement in the discussion, but a pretty steady path in the execution.
That's correct.
Okay.
So that's a quick overview on what we saw in the markets. Let me pause there for a second. Any thoughts or questions? All right. Well, let us continue to how the investments performed. And as most of you who've attended before, we always start with this graph, which is what for me is maybe one of the things that I think we're most proud of here at ForUsAll. When we look across our entire book of business, we see generally about 75 to 80% of all assets are in an age-appropriate target date fund. When we look at that number based on the percentage of participants, it's closer to 85 to 90% of employees are in the age-appropriate target date fund. That's great for a couple of reasons. First, we know they're in a diversified risk-appropriate portfolio. That's the number one thing that we need to be doing as an advisor to your employees. Second, it often begs the question, when employees are in the age-appropriate target date fund, there is a safe harbor under ERISA that provides additional protection to use a plan sponsor. Essentially, so long as we've done a prudent job selecting the target date funds, which we have, then an employee has very limited recourse to be able to have a suit alleging that they didn't have enough information to make an informed choice in the plan. So seeing this is not only great for employees, but it's also great for all of us with that ERISA safe harbor. It does beg the question, though.
What's in that gray area?
What's in that gray area? And this is what we look at. And this also looks great to me. What we see is basically about a 90-10 stock bond split. But it's very diversified. So when you look at the allocation across the different asset classes, you tend to see the weighting in the S&P 500 versus the total stock, or versus small cap and mid cap and international, and then the split between the short term and total bond market generally are in line with what you would expect given the overall market portfolio, which suggests that even employees that are managing their own portfolios in aggregate actually have a pretty balanced view. I will note, though, that the stock bond split has actually been slowly increasing over the last couple of quarters. And there are two factors behind this. The first factor is that with the exception of the last part of the quarter, equity markets have been doing pretty well. And that just all else means that the equity portion of people's portfolios are going to be growing faster than the bond portion, which would lead to more weight in equities. The second factor is there have been more young employees that are actually entering the plan. And so all else equal, you would expect the aggregate portfolio then to take on a little bit more stock exposure given that new mix of the demographics of the pool.
And a 90-10 split is roughly what you would want if you were under, say, age 45.
That's correct.
As an investment. Okay, great.
Okay. So that's the quick overview on what the portfolios are looking like. Let me pause there. Any thoughts or questions on what we see employees doing with their assets? All right. Well, let's dive into how the funds performed. So this is always probably the most boring part because it's going to be the same story. Generally, it's a coin flip over a quarter whether or not the index fund approach is going to outperform the actively managed or median fund. But when we look at the 5 and the 10-year, that's when we tend to see the low-cost indexing pull ahead. Well, certainly see that. So large caps over the quarter, the Vanguard S&P 500 and the total stock ended up losing money, as did the overall equity market, but they lost less than the median fund. Similarly, they outperformed peers, though, much more when you look at the 5-year and the 10-year. And the magnitude of this outperformance is really close to about 1%. So that's literally 10% more money over a 10-year period um, just from staying away from the more expensive actively managed funds.
Really adds up over time.
Then let's take a look at the mid cap. Same story. There really is a very small little blue sliver right there. So it's down.
Above zero.
Mid caps were down slightly over the quarter, certainly beating out a lot of the mid cap equity funds. And this is always funny to me because I always hear this, depending on whatever market environment you're in, you always hear two things. One, well, index funds do great in up markets, but you really want active management in the down markets. Well, we had a down market and didn't seem like active management did much better. In fact, they did considerably worse. And that's because oftentimes they can take significant active bets that may or may not work out. Last quarter for both large and now mid certainly didn't. 5 year, again, you see the mid cap equity. 5 and 10, you see them pull ahead. Turning to the international equity, small cap rather. Same story over the quarter. Indexing certainly won and posted a small loss relative to the peers, which were down closer to about 50 basis points, 40, 50 basis points. Over the 5 and the 10 year, again, you see them pull ahead quite substantially, around a 1 to 1.25% per year. International equity a little bit more flat. Again, outperformed over the last quarter, even in the down market, edging out a little bit over the 5, a little bit more over the 10. So that's the quick review of the stock funds. On the bond fund side, a little bit more mixed. Basically neck and neck across the board for both the total bond fund and then the short-term bond fund. Basically here it's much more of a tie with maybe 5 or 10 basis points difference between the two. Now that describes what about maybe 10% of employees got, but does beg the question, well, what happened to those 90% which were in the target date funds? Well, let's take a look. What we see across the target date funds is essentially across the board, everything was down. However, the Vanguard target date funds, which are in all of your plans, didn't lose nearly as much as the median funds did. And this is actually really telling. And I think when we see more and more down markets, this is where the Vanguard funds tend to perform very well. And it's for two reasons. When we look at the other target date fund series, some of them, like, for example, the Fidelity target date fund, which is a very popular one, tend to take significantly higher allocations to equity. So they'll have more stocks and fewer bonds across the entire age spectrum. But then you have funds like a T. Rowe Price fund, which is more similar in terms of the total equity exposure. So when you look at it, it seems like it has a similar risk profile to the Vanguard. But then when you look beneath the hood and look at what they're holding in the bond portfolio, that's where the high yield rears its ugly head. And so a lot of target date funds, in addition to taking slightly higher equity exposure, oftentimes will load up the bond portion of their portfolio with rather large allocations to high yield or non-investment grade bonds. Now, in down markets, while investment grade bonds tend to benefit from a flight to safety, basically people getting rid of risky stuff and trying to hold on to more conservative investments, they don't get that benefit. And in fact, while the overall interest rate might be declining as people fly to safety, the risk-free rate might decline. Credit spreads tend to widen. And so in down markets, high yield bonds start to behave a lot more like stocks. And so you can lose that diversification benefit. And certainly that may have been what was behind the better performance of the Vanguard over the last quarter when we had that down market. But of course, when we look at the 5 year, they really pull ahead, and the 10 year. Again, depending on what year you're looking at, this is basically about 75 basis points to about 1.5% better return, depending on which vintage you're looking at. So overall, Vanguard still performing very strong relative to peers. In fact, I just looked. They now have 5 years in a row of a gold Morningstar rating. I think they outperformed over the last 10-year period about 80% of all other target date fund managers. And it's one of the reasons why they've become quickly one of the gold standards for target date funds and plans. In fact, I just looked at some recent numbers, and basically 32 cents out of every dollar in a target date fund is now in a Vanguard target date fund. Last year, out of every dollar, about 60 cents, give or take, went into of every new dollar into a target date fund, about 60 cents went into a Vanguard target date fund. And a lot of that is for the same reasons that we've just illustrated. They have very strong historical performance. They're a fee, which ranges in the 0.14 to 0.16 range, is about 1/6 the cost of an average target date fund. And they've just have that strong, stable management that has performed well in both the down market and now the market upswing. So that's a quick overview of how the investments performed. Let me pause there for a second. Any thoughts or questions? Okay. Well, that is the end of the investment portion of the quarterly investment committee review. I'd love to pause here and just open it up to a couple of questions. Are there any questions outside of what we've covered that I could answer, or any thoughts, feedback?
Absolutely anything. Just let us know.
Okay.
No takers.
Are there any specific topics that would be helpful that we cover next quarter? Okay.
Well, if you do have any other thoughts on what we should, what we'd like to hear a little bit more about next quarter, or if you have other questions that you didn't want to raise here, don't hesitate. Give us a call. Shoot us an email. We're happy to pick up the phone or respond very quickly and address any other concerns you might have.
Fantastic. And maybe one last question. Are there any ways that come to mind where we can improve?
Feedback is always appreciated.
All right. Well, we'll follow up with you individually after this, because I'm certain there are ways that we can improve and do a better job. So definitely look forward to any feedback you have, positive, but more importantly, any constructive feedback on how we can do even better. We'd love to hear it. On that note, thank you so much for spending another Friday afternoon with us. It's always a fun time to geek out on investments.
Our pleasure.
And look forward to chatting with you all soon.
All right. Have a great rest of the week.